Welcome to Talk Tickers. I'm your host, the voice of the trading desk, the guy who looks at the numbers while everyone else is kind of just looking at the narrative. And I have to be completely honest with you right off the top here. When you sent over the stack of research for today's deep dive, my first instinct was to just drag the entire folder straight into the trash bin.
I had a feeling you might say that. It's definitely a lot of paper to get through.
It wasn't just the volume, though. It was the topic. I saw carbon markets on the cover sheet, and I just thought, great. Another 50 pages on saving the rainforests and corporate social responsibility and, hugging trees. I really thought we were going soft. I thought we were leaving the hard-nosed world of P&L and entering this fuzzy world of PR.
And that is exactly why we need to have this conversation. Because that reaction, that exact dismissal of carbon as a soft topic is precisely where the market inefficiency is right now.
That's what actually hooked me once I forced myself to read it. I started reading the notes you made on phantom credits and the balance sheet liabilities for major airlines, and I realized this isn't an environmental story at all, at least not for us. This is a pure valuation story. This is a massive short-selling thesis just hiding in plain sight.
It really is. It's a story about distressed assets. You have some of the biggest companies in the S&P 500 carrying assets on their books, these carbon neutral badges and the credits backing them, that might effectively be totally worthless, technically insolvent.
So let's be very clear about our mission today for everyone listening. We are not here to debate climate change. We aren't here to moralize about the environment. We are here to talk about regulatory arbitrage. We're talking about a massive gaping spread between price and value that is currently blowing up in the faces of corporate treasurers all over the world. We are doing a complete teardown of the carbon market.
And it is a fascinating and messy and frankly dangerous time to be holding these assets if you don't know exactly what you're doing.
So let's set the stakes for the listener right away. Why should they care about this right now? Why is this urgent?
Because the bill is finally coming due. For the last 5 or 10 years, corporations have treated the carbon market as just a marketing expense. You pay a broker, you buy some credits for a few dollars a ton, you slap a net zero sticker on your annual report, and you go back to business as usual. It was cheap, it was easy, and honestly, nobody really checked the math.
It was just a check-the-box exercise for the ESG committee.
Exactly. But that era is completely over. We are seeing a real convergence of data availability, investigative journalism, and aggressive litigation that is actively exposing the underlying quality of these credits. And it turns out a massive portion of them are phantom credits. They just don't represent real carbon reductions.
And when an asset turns out to be worthless, the liability doesn't just poof, vanish into thin air. It comes back to bite you. It comes back as consumer fraud lawsuits. It comes back as forced restatements of environmental impact. It comes back as reputational radioactive waste.
All right. If you're an investor and you see carbon neutral on a balance sheet, you used to think, oh, good corporate citizen. Now you need to look at that and think, potential massive litigation risk.
So today we're going to dissect this entire beast. We need to distinguish between the compliance market, where the real money actually trades, and the voluntary market, which is the Wild West that we really need to worry about. We're going to look at the mechanics of the trade, the scandals that crashed the price, and the future of the asset class.
And we're going to focus heavily on the core tension that's driving all this repricing. That's the shift from avoided emissions, which is paying someone not to cut down a tree, to carbon removals, which is actually taking the carbon physically out of the air. That pivot is exactly where the smart money is moving right now.
Let's start with the absolute basics, because I think even highly sophisticated investors get this entirely wrong. When I look at a trading terminal, I see carbon listed as a commodity, but it feels like we're actually talking about two totally different things here. Is the stuff that Delta Airlines is buying the exact same stuff the European Union is regulating?
No. And confusing them is a fatal error for an investor. They are almost entirely non-fungible. You really have two parallel universes operating here.
Let's start with universe number one, the compliance market.
This is the serious side, the real money side of the equation. Think of the European Union emissions trading system, the EU ETS, or the California cap and trade system. These are legally binding systems created by governments.
We always hear that phrase cap and trade, but let's walk through the actual mechanism. Is it just a fancy word for a tax?
It's absolutely not a tax, and that distinction matters a lot for a trader. A tax sets the price of carbon, say $50 a ton, but lets a quantity of emissions float. You can pollute as much as you want as long as you're willing to pay the $50. Cap and trade does the exact opposite. It fixes the quantity that's the cap and lets the open market determine the price.
So the government steps in and says, okay, Entire continent of Europe, you are allowed to emit exactly X billion tons of CO2 this year, and not a single ounce more.
Correct. And they issue allowances, which are basically just permission slips that equal that total cap. If you are a power plant or a massive steel factory, you legally must surrender one allowance for every single ton of CO2 you pump out of your smokestacks. If you don't have enough caps, you face massive fines. So you have to go into the market and buy them from someone who has extras.
And the government doesn't just leave that cap static year over year, right? That would be way too easy for these companies.
No, the cap shrinks. That's the ratchet mechanism. Every single year, the EU issues fewer and fewer allowances. They are artificially creating market scarcity.
Which in basic economics means the price inevitably has to go up.
In theory, yes. It forces the price up over time, which creates a real financial incentive to decarbonize your operations. Think about it. If the allowance costs 100 euros, but installing a new high-tech filter on your smokestack only costs 80 euros per ton of reduced carbon, you just install the filter. The market finds the most economically efficient way to cut emissions across the board.
And the volume we are talking about here is just massive. I was looking at the data from the terminal. In 2022, the trading volume on the EU ETS alone hit 751 billion euros. That's not some niche little green experiment. That is a mature, highly liquid global commodity market.
It covers about 20% of all global emissions. It's heavily regulated, it's standardized, and it's tightly policed. If you are trading EUAs, those European Union allowances, you are trading a very real hard asset.
Okay, so that's the adult table. Now we have to talk about the kids table, the voluntary carbon market, or the VCM.
The absolute Wild West. This is the market that grabs 99% of the media headlines, even though it covers less than 1% of actual global emissions.
This is where the tech company, the airlines, the big coffee shop chains all live.
Right, because absolutely nobody is forcing them to do this.
Yeah.
There is no federal law saying a software company has to be carbon neutral. They do it for brand reputation, for shareholder appeasement, or just to attract young talent. It's entirely discretionary.
And because it's discretionary, there is no centralized regulator. There is no government setting a hard cap. So who is actually the sheriff in this town?
That is the fundamental problem. There isn't one. Instead of a government regulator, you have private nonprofits called registries. The big ones you'll hear about are Vera Gold Standard and the American Carbon Registry. They set their own rules, they certify the independent projects, and they are the ones who issue the actual carbon credit.
Let's define that asset clearly for the listener. In the compliance market, the asset is a permission to pollute. What exactly is the asset here in the voluntary market?
In the voluntary market, a carbon credit is simply a certificate that says I paid for 1 metric ton of CO2 to be removed or avoided somewhere else in the world.
And the pricing spread between these two markets is frankly insane. Compliance credits in Europe can easily trade at 80, 90, even 100 euros a ton. But voluntary credits, what are we looking at there?
We've seen them trade for $1 or $2, sometimes literally pennies on the ton.
Which should be a screaming siren of a red flag to any quantitative investor. Markets are generally pretty efficient over the long run. If one asset costs $100 and another asset that claims to do the exact same physical thing costs $2, the $2 asset is almost certainly garbage.
It's the oldest adage in finance. You get what you pay for. The institutional market has been pricing in a massive risk discount on these voluntary credits because the underlying quality is highly suspect.
Let's really dig into why that quality is suspect. But first, I think we need a little bit of a history lesson. Because this isn't actually the first time this specific market has completely imploded. We've seen this exact movie before, haven't we?
We definitely have. We can go all the way back to the mid-2000s. The Kyoto Protocol days, there was a mechanism called the CDM, the Clean Development Mechanism. It was officially UN-backed.
The core idea there was basically a wealth transfer from developed to developing nations, effectively.
In a way, yes. Developed countries which had strict emissions targets could pay for clean infrastructure projects in developing countries. It sounded beautiful on paper. The pitch was, I'll pay for a brand new hydro dam in India, and that counts against my factory emissions in Germany.
Sounds great, but the execution was what?
It was a total disaster. The market was immediately flooded with incredibly low quality credits. There were infamous scandals. The biggest one was the HFC 23 issue.
Oh, I actually remember reading about this in the prep. This was the coolant gas, right?
Yes. HFC 23 is a super potent greenhouse gas. It's literally thousands of times worse for the atmosphere than standard CO2. Factories primarily in Asia produced it as an unwanted byproduct of making normal refrigerants for air conditioners. The UN formula paid them massive amounts of carbon credits to destroy this waste gas. It paid so incredibly well that the factories realized the carbon credits were more valuable than the actual refrigerant they were selling.
So wait, they started producing more of the refrigerant just so they could create the toxic byproduct, destroy it, and claim the credits.
Exactly. They were literally manufacturing extreme pollution just to get paid to clean it up. It was the ultimate perverse incentive. Eventually, the broader market realized the confidence completely collapsed, and by 2014, the price of those CDM credits crashed to effectively zero. The entire market basically died overnight.
But like a financial zombie, it somehow came back to life. Around 2018 or 2019, we saw this huge resurrection. Why did that happen?
The corporate net zero rush. The Paris Agreement really changed the global corporate conversation. Suddenly, every Fortune 500 CEO needed a glossy ESG slide in their quarterly deck. Larry Fink at BlackRock was sending out those annual letters demanding climate action. Consumers were waking up. But here is the massive structural problem. Decarbonizing a massive multinational company is incredibly hard.
It's practically impossible in the short term. If you're a major airline, you can't just switch your entire fleet to electric planes tomorrow, and the technology literally doesn't exist yet.
Right. And if you're a massive global food company, you can't just force 10,000 independent farmers across 3 continents to change their fertilizer usage overnight. These things take massive capex, they take years of R&D, and they take a lot of time. But the corporate marketing department wanted to say net zero today.
So they looked for a financial shortcut.
And the shortcut was the carbon offset. Buying a credit is just an OpEx line item. It's so easy. You cut a check to a broker, you get a fancy digital certificate, and you claim carbon neutrality in your next press release.
And the cheapest, most abundant credits available were these avoidance credits, specifically avoided deforestation.
REDT plus is the technical industry term, reducing emissions from deforestation and forest degradation. And the narrative is incredibly compelling for a brand. The pitch is pay us and we will protect this beautiful, pristine patch of the Amazon rainforest from illegal loggers.
I mean, who doesn't want to save the rainforest? It's the perfect PR spin. It saves the planet, it saves the exotic jaguars, and it perfectly balances the corporate carbon books.
And for a few years, it was an absolute gold rush. Prices ticked up, trading volume exploded. Everyone from Delta to Gucci to Disney was buying these things in massive bulk quantities.
And then 2023 happened, the Great Correction.
The bubble didn't pop because of macro interest rates or inflation. It popped because the underlying asset was fundamentally exposed as fraudulent.
We're talking about the joint investigation by The Guardian, Dicite, and Source Material. They didn't just write a speculative op-ed, they did a deep forensic data analysis on the registries.
They looked incredibly closely at the scientific methodologies used by Verra, which is the world's leading certifier of these projects. And their conclusion was just devastating to the market. They suggested that more than 90% of the rainforest offsets verified by Verra were effectively totally worthless.
90%. Let's just pause on that number. If 90% of the corporate bonds rated AAA by Moody's turned out to be absolute junk, the entire global financial system would collapse in a day.
Precisely. They found that the imminent threat to the forests had been overstated by massive, absurd margins. In some specific cases, the threat was overstated by 400%.
This is where we really need to get into the weeds for the listeners. We need to explain exactly how you fake a carbon credit. Because I think sophisticated investors hear the word fraud and they want to know the exact mechanism of the trade. How do you print phantom credits out of thin air?
It all comes down to how a credit is officially born. The life cycle involves a project developer, those are the guys on the ground in the jungle, a registry acting as the certifier, and a broker who sells it. But the magic and the ultimate deception happens entirely in the math.
Let's talk about additionality. You circled this word about 10 times in the prep notes. Why is this specific concept the smoking gun?
Because additionality is the single only thing that separates a legitimate carbon credit from just a nice charitable donation. For a credit to be financially valid, you have to conclusively prove that the emissions reduction would not have happened without the money from selling the credit.
Okay, let's play this out with a hypothetical. Let's say I own 100 acres of gorgeous woods in upstate New York. I love those woods. I walk my dog there. I was never, ever going to cut them down. Can I call up a broker and sell carbon credits for my woods?
In a properly functioning market, absolutely not. Because your forest is already safe. Paying you changes nothing about the physical world. If I pay you $1 million and you keep the trees, the atmosphere is in the exact same state it would have been in if I hadn't paid you a dime. That is the definition of non-additional.
But if I'm a savvy, ruthless developer, I don't go to the registry and say, I love these woods. I go to them and say, hey, times are incredibly tough right now. I'm actively planning to clear cut this whole 100 acres and put in a massive concrete strip mall. But if you pay me for carbon credits, I won't do it.
And now we have the core structural problem. You are asking the market to pay for a counterfactual. You are asking investors to pay for a hypothetical what-if scenario. The developer has to create a baseline scenario, which is a detailed story about what would definitely happen without the project funding.
And obviously, as the developer, I have a massive financial incentive to tell the scariest, most apocalyptic story possible. I'm going to say the loggers are literally revving their chainsaws at the property line right now.
Exactly. This is known as baseline inflation. The journalistic investigation found that developers were systematically gaming this baseline. They would use things called reference regions to legally prove the imminent threat.
Explain that mechanism. What exactly is a reference region?
To prove your specific forest is in danger, you have to look at a nearby geographic area that is scientifically similar to yours. If that reference area is currently being aggressively deforested, you argue to the registry that yours will be too.
Sounds logical on the surface.
It is logical until you start to cheat the geometry. The investigation found developers were aggressively cherry-picking their reference regions to maximize the threat. Let's say your actual conservation project is located in a highly remote mountainous part of Peru that is incredibly hard to access. Nobody is logging there because it's just way too expensive to get the heavy machinery up the mountain and transport the wood out. But the developer picks a reference region that happens to be completely flat, right next to a major newly paved highway in a rapidly growing city.
So the reference region is getting absolutely decimated by loggers because it's cheap and accessible, and the developer points to that and says, look at the data, my remote mountain is next.
Even though any rational logger has zero economic incentive to ever climb that mountain, they use that false geographic comparison to artificially inflate the baseline scenario. They claim their remote forest was 100% going to be wiped out next year. When it predictably stays standing, they claim full credit for saving it, and their registry issues them millions of highly profitable credits.
So the Fortune 500 company buying the credit paid for absolutely nothing. They paid for hot air.
And the global atmosphere saw zero net benefit. The temperature still goes up.
Then you have the leakage problem on top of all that, which sounds like a bad plumbing issue, but in carbon economics, it's a geographic displacement issue, right?
Okay. Imagine squeezing a long balloon. If you squeeze one part of the balloon, the air doesn't just disappear from existence, it just bulges out somewhere else. Global logging is driven by raw macroeconomic demand. People need timber to build houses, or they need cleared land to graze cattle or grow soy.
So if I pay a landowner handsomely to tightly protect this specific 1,000-acre plot plane,
the logger doesn't just retire and go home. The global demand for soy doesn't suddenly vanish. The logger just packs up his trucks, moves a mile down the dirt road to the very next acre, the one that isn't part of your protected project, and just cuts that one down instead.
So the net global carbon benefit is exactly zero. You didn't stop the deforestation, you just literally moved the chainsaw a mile down the road.
Correct. And while modern methodologies try really hard to account for this leakage in their math, it is incredibly difficult to accurately measure on a global scale. When you combine systematic baseline inflation with rampant leakage, you end up with a portfolio of assets that look fantastic on a corporate PDF, but are physically and mathematically meaningless.
And meaningless assets eventually become massive toxic liabilities. This brings us to the real shift that makes this a talk tickers topic today. We are rapidly moving from this just being bad PR to actual hard legal risk. Let's dive deep into the litigation side.
This is exactly what is keeping general counsels up at night right now. It used to be that if you were caught holding bad credits, you got a nasty article written about you in the press. You issued a generic corporate apology, maybe you quietly fired a mid-level sustainability officer, and you moved on. Now you get hit with a class action lawsuit.
We've got major active cases against Delta Airlines, KLM, Apple. But the legal angle here is what's truly interesting. It's not just environmental activist groups suing for the trees. Who is actually driving this litigation?
It's consumer protection lawsuits. Massive class actions brought by regular customers.
What is the specific legal argument they are making in court?
The argument is straightforward consumer fraud and false advertising. Let's look closely at the Delta Airlines case that was filed in California. Delta aggressively marketed itself for years as the world's first carbon-neutral airline.
Which is an incredibly bold claim for a company whose entire business model relies on burning millions of gallons of jet fuel every day.
Very bold. The plaintiffs in the lawsuit argued that everyday consumers, people like you and me booking a flight, were actively willing to pay a premium ticket price, or at least choose Delta over a competitor, specifically because of that carbon-neutral promise. It was a core part of the product's value proposition to the market.
So if the offsets backing that central claim are exposed as junk,
then the product itself was legally defective. You fundamentally didn't get what you paid for. The legal argument is essentially, I paid for a clean carbon-neutral flight to New York. You gave me a dirty flight backed by phantom baseline inflated credits. That is fraud under California law.
that is a wildly dangerous precedent for corporate America. Because if a federal court officially rules that carbon neutral is a strict warranty claim, companies are going to be on the hook for billions in refunds and damages.
Exactly. And we've already seen a major ruling in Europe. In the Netherlands, a court recently ruled against KLM. The court explicitly stated that their Fly Responsibly campaign was highly misleading because the cheap offsets they bought couldn't mathematically guarantee the environmental impact they were claiming. The judge effectively told the corporate world, you cannot promise neutrality to consumers based on these highly uncertain, low-quality assets.
And it's not just consumers in the West filing these suits. We are seeing courts in the Global South getting heavily involved now, too.
This is a totally new and critical development for risk managers. We are seeing significant legal rulings in Kenya, Peru, and Colombia. These local challenges are questioning the fundamental land rights and the legal validity of the projects themselves at the source.
Which perfectly brings up the human rights violations angle. This is the stuff that makes institutional investors really queasy. We aren't just talking about ineffective math projects anymore. We're talking about actively harmful operations.
Yes. There is a deeply flawed model of conservation in this space, often called fortress conservation. The core idea is to draw a hard line on a map around a valuable forest and say absolutely nobody touches this area.
But people actually live there. Indigenous communities have lived in those forests for generations.
Exactly. And to ruthlessly enforce the boundaries of the carbon project, developers sometimes hire heavily armed private security, or they work directly with local militarized police to actively evict those people. We have very specific documented examples of this. Look at the Alto Mayo project in Peru. This was considered a flagship gold standard project. Massive companies like Disney bought credits from there.
Disney, arguably the most family-friendly brand on the face of the earth. And yet there are highly credible reports of local residents' homes being physically demolished, forced evictions at gunpoint, midnight police raids, all designed to secure the perimeter of the carbon credits so they could be sold to Western corporations. Just imagine trying to explain that specific line item to your institutional shareholders at the annual meeting. Yes, we achieved our net zero goals this quarter, but we had to actively bulldoze a few indigenous villages in Peru to get the math to work.
It is an unmitigated reputational nightmare. There was another massive investigation into projects in Cambodia that involved armed rangers patrolling the jungle and reports of widespread systemic fear among the local indigenous groups. And down to the Brazilian Amazon, we've seen sweeping federal police raids on major carbon credit projects that were allegedly linked directly to illegal timber laundering.
Wait, just pause on that for a second. Timber laundering, how does that even work?
Yes. The formal police allegation is that the carbon project's legally protected status was actively being used as a front to launder illegally harvested timber from outside the zone. So you have a financial mechanism explicitly designed to save the forest, potentially being weaponized by cartels to hide the destruction of it.
If you are an equity investor and you see carbon neutral proudly displayed in a company's 10K and you dig into the footnotes and find out that claim is backed by a project in Brazil that is currently being raided by the federal police for cartel activity that is not just an environmental risk, that is a catastrophic governance failure.
It creates a massive, unquantifiable overhang on the stock. And that is exactly why the market is evolving so aggressively right now. We are seeing a massive institutional flight to quality. The smart money is totally abandoning the Wild West and moving rapidly toward assets with verifiable structural integrity.
Let's transition and talk about that evolution, because if the old market of cheap avoidance credits is effectively dead, what does the new investable market actually look like? The roadmap seems to be something called the Oxford Principles.
The Oxford Principles for Net Zero Aligned Carbon Offsetting. It's a bit of an academic mouthful, but it is effectively the brand new gold standard for portfolio construction in this space. It lays out a strict hierarchy of quality that every single CFO in the Fortune 500 should have printed out on their desk right now.
Break it down for us. What's the first major shift?
Shift 1 is brutal but necessary. Cut your own actual emissions first, scopes 1, 2, and 3. You cannot financially offset your way out of a fundamentally dirty business model anymore. Offsets are now strictly the absolute last resort, reserved only for the very last residual emissions that you absolutely cannot engineer out of your process yet.
So the era of I'll just keep burning cheap coal, but I'll buy a forest in Indonesia to make the math look good, that's over.
Completely over. That doesn't fly with regulators or investors anymore. But shift 2 is the real technical pivot. This is the one that equity investors really need to watch closely. The mandate is to move entirely from reduction to removal.
We touched on this briefly earlier, but let's really drill down into the mechanics. What is the fundamental physical difference?
A reduction or avoidance credit, like all those rainforest projects we just aggressively bashed, is paying someone else not to emit carbon. I pay you not to cut that tree. I pay you not to build that coal plant.
Which carries all the counterfactual baseline inflation and leakage problems we just spent 20 minutes dissecting.
Exactly. It's totally hypothetical. A removal credit, on the other hand, is paying a company to physically, violently take carbon dioxide molecules completely out of the ambient atmosphere.
Give me the tangible examples of what that looks like in the real world.
Well, nature-based removal would be true afforestation, meaning actively planting a brand new forest on degraded land where there absolutely wasn't one before. As the new trees grow, they suck CO2 out of the air to build their physical trunks and leaves.
Okay, that's the biological approach. What is the hard tech approach?
Technology-based removal includes things like direct air capture, or DAC. Think of massive industrial fans like the ones at the huge Climeworks plant up in Iceland. They suck millions of cubic feet of ambient air through a highly specialized chemical filter trap, the CO2 molecules, and release clean air out the back.
This totally solves the additionality problem we talked about, doesn't it?
It solves it completely.
Yeah.
There is absolutely zero counterfactual to debate. You can legally weigh the captured CO2 on a scale. You can measure it down to the gram. It is a tangible physical asset. You put exactly 1 ton of carbon deep into the ground. It's not a creative story told by a developer. It's just raw physics.
So if it's that perfect, why isn't every single corporation just doing this right now?
Price. It all comes down to the spread. A highly questionable avoided deforestation credit might cost you $3 a ton. Direct air capture is currently trading somewhere around $600 to maybe $1,000 a ton.
Ouch. So doing the mathematically correct thing costs roughly 300 times more than doing the easy PR thing.
Which is exactly why the market is aggressively bifurcating. But the fundamental price of removal will inevitably come down as the technology scales up. And shift 3 of the Oxford Principles helps justify paying that massive premium. That shift is the requirement for durable storage.
This addresses the permanence risk, the risk of the asset literally going up in smoke.
Right, because if you just plant a tree, that carbon's only stored for maybe 50 or 100 years tops.
Yeah.
But if that new forest burns down in a wildfire, which is happening exponentially more often with climate change, all that stored carbon goes right back into the atmosphere in an afternoon. That's called a reversal event. The financial asset you bought just completely evaporated.
But if you use the hard tech approach,
If you take that pure CO2 from the direct air capture plant and you inject it a mile down into basalt rock formations underground, it actually mineralizes. It chemically turns into a solid stone. It is permanently stored for thousands or even millions of years. That is truly durable. The Oxford Principles say we must migrate all corporate portfolios toward this long-term geological durable storage.
so the corporate balance sheet of the future isn't a line item that says I protected a hypothetical forest in Peru. It's a line item that says I paid a high-tech facility in Texas to turn my carbon waste into solid underground rock.
That is the new absolute gold standard. But because that tech is still so prohibitively expensive today, we are seeing another massive macro trend emerging as a bridge: the rapid rise of insets.
Offsets versus insets. I have to admit, this feels a bit like corporate buzzword bingo, but the actual distinction here is really about supply chain arbitrage, isn't it? Walk us through the mechanics of an inset.
Let's start with the baseline. An offset is purely external. Let's say you are a massive airline headquartered in Texas. You buy a carbon credit from a random wind farm located in Turkey. There is absolutely zero physical or economic connection between your aviation business and that Turkish wind farm. You are just legally buying the rights to their good deed.
Okay, I'm with you. And an inset is what?
An inset is taking that exact same capital and investing it directly into your own proprietary supply chain. Let's look at a concrete financial example. Take a giant global cereal manufacturer, somebody like General Mills or Kellogg's. They have massive Scope 3 indirect emissions coming entirely from the thousands of independent farms that grow their raw grain.
You mean emissions from the heavy diesel tractors, the synthetic fertilizer, the soil tilling, all of that?
Right. In the old days, the cereal company would totally ignore the actual operations of those farms and just buy cheap rainforest credits in Brazil to magically offset the pollution on paper. But with true insetting, they take that exact same budget and they go directly to the actual farmer in Iowa who grows their specific wheat.
And what's the pitch to the farmer?
They offer a direct financial incentive. They say, we will pay you a premium per bushel to actively plant cover crops in the off-season. We will pay to upgrade your equipment so you use precision low-nitrogen fertilizer.
So the actual carbon reduction happens on the literal physical ingredients that go into the final cereal box.
Exactly. The environmental benefit stays entirely within the product's actual life cycle. It's verified entirely within the company's own closed-loop Scope 3 reporting system, and it gives the parent company way more operational control. They aren't relying on some shady third-party developer in a different country who might be systematically lying about a baseline. They're relying on their own direct suppliers.
And from a pure legal liability standpoint, this is infinitely safer for the board of directors. It's incredible, which is exactly the kind of language that a CFO actually understands and respects. So, bringing this all back to the pure investor perspective, what are the immediate portfolio implications here? Because based on everything we've discussed, we are seeing a violent split in the market.
We are seeing a massive structural bifurcation. The asset class is rapidly splitting into junk grade and investment grade.
Junk grade being all the old vintage stuff we talked about.
Yes, old renewable energy credits, which are now cheaper than dirt because building a solar farm is highly profitable on its own, so it completely fails the additionality test and all that unverifiable avoided deforestation. Prices for these specific assets are absolutely cratering. Market liquidity is totally drying up. If a publicly traded company is stubbornly holding these on their balance sheet today, they are holding a rapidly depreciating, highly toxic asset.
And the investment grade side of the split.
Verified hard removals. Things like biochar, direct air carbon capture and storage. The available supply of these high-quality credits is incredibly low right now, but the corporate demand is absolutely skyrocketing. Prices are holding very firm or even rising in a tough macro environment. We saw corporate retirements of nature-based removals from 25 just recently. The corporations that are actually serious about this, the Microsofts, the Stripes, the Shopifys of the world, they are aggressively bidding up the price of the good stuff.
So if I'm an analyst or a portfolio manager looking at a company that proudly claims net zero on page 1 of their 10K, I need a strict due diligence checklist. I cannot just take their marketing department's word for it anymore. What exactly am I asking management on the next call?
You need to ask 3 very hard, very specific questions. Question 1, are they actively using cheap offsets to mask a fundamental failure to decarbonize their actual core operations? Look closely at their gross unadjusted emissions trend over 5 years. If their gross operational emissions are steadily going up, but they claim net zero only because they bought a mountain of offsets, that is a massive operational risk.
That's what I call the diet pill while eating donut strategy. The fundamentals are still terrible.
Exactly. It's totally unsustainable. Question 2. What is the specific vintage of the credits they are holding? If you dig into the registry and see they are holding credits generated back in 2016 or 2017, those are almost certainly using the old, deeply flawed baselining methodologies. They carry an extreme risk of being exposed as worthless.
And question 3.
Look at the composition. Is their credit portfolio heavily weighted toward avoidance, or is it shifting to removal? You want to see a clear strategic shift toward physical removal. If 100% of their carbon strategy relies on avoided deforestation, they're sitting on a ticking PR and legal time bomb.
And I'll add a 4th check for the traders out there, litigation watch. Are there consumer marketing claims writing massive checks that their low-quality carbon credits fundamentally cannot cash? If they're blasting carbon neutral on every single billboard and TV commercial, but you check their filings and they're only buying $2 avoidance offsets, you might want to consider shorting the stock.
Or at the very least, heavily hedge your exposure. Because the macro view from institutional desks is crystal clear. The long era of cheap, easy offsets is totally ending. The base cost of doing business for these heavy emitters is rising dramatically. If a company relied entirely on $2 credits to maintain their operating margins, those costs are about to go up 10 times or 20 times when regulators force them to switch to high-quality removals.
That inevitable margin compression is going to catch a massive amount of equity analysts totally off guard next year. And hard regulation is coming to the voluntary market too, isn't it? It won't be voluntary for much longer.
It absolutely is. The CFTC in the US, the strict EU regulators, everyone is actively looking at this space right now. The voluntary market will inevitably start looking a lot more like the compliance market over the next few years. Way more stringent rules, much higher verification standards, and vastly higher clearing prices.
Which perfectly brings us to our signature segment, the one question. We always want to leave you, the listener, with one highly targeted question to ask management on the very next earnings call, or to ask yourself when you're tearing through a new 10K.
The defining question is this: is this specific credit an avoided emission based on a hypothetical counterfactual, or is it a verified physical removal with durable long-term storage?
And why does that specific distinction matter so much? Give it to us in one sentence.
Because avoidance is just accounting arbitrage that is rapidly becoming a massive legal liability, while removal is a tangible physical asset with real long-term intrinsic value.
That is the core trade right there. You never want to be long a liability masked as an asset.
Never. It's the quickest way to blow up a portfolio.
Let's quickly wrap this up with the conclusion segment. I want 3 hard key takeaways for the road before we close out.
Takeaway 1. The golden era of phantom credits is completely ending. The broader market is aggressively repricing the immense risk on rainforest and avoidance offsets. If you're holding these legacy assets, mark them down to 0 right now.
Takeaway 2, there is a massive hard pivot happening from external offsets to internal insets. Smart companies are moving their capital directly into their own physical supply chains to tightly control the data, the methodology, and the final outcome. Watch very closely for the companies actively investing in their own suppliers. They are the ones successfully future-proofing their operating margins.
And takeaway 3, intense regulatory and legal scrutiny is rapidly transforming carbon credits from a simple, innocent marketing expense into a highly complex and dangerous compliance risk. If a company isn't doing deep forensic diligence on what they are buying from these brokers, they are literally painting a giant target on their back for consumer class action lawsuits.
It's a fundamental shift from the marketing department to the balance sheet. You have to treat it exactly that way. Keep your downside risk perfectly hedged. Dig deep into those registry footnotes, and whatever you do, don't just blindly believe the corporate hype. But before we go, I want to leave you with one final, slightly provocative thought to chew on. If these massive carbon liabilities do blow up and these companies are forced to restate years of environmental claims, what happens in a corporate bankruptcy? Does the environmental liability to clean up the actual physical carbon they emitted become senior to the unsecured debt holders? Because if the courts decide that climate liabilities take precedence over bondholders, the pricing of corporate debt for heavy emitters is fundamentally wrong right now. Think about that the next time you look at a utility company's yield. This is Talk Tickers.
See you next time.